Welcome, everyone, to today's Explainer. I'm absolutely thrilled to be your guide as we get hyper-focused on a really specific, but honestly massively influential corner of the global economy. Today, our goal is to demystify exactly how pure-play investment banking is categorized for sustainability reporting. We're talking about the strict definitions that dictate how literally billions of dollars in investments are scrutinized and how standard setters actually classify the moving parts of these giant global financial institutions. If you've ever wondered how regulators draw these high-stakes boundary lines, well, you're in the right place. We are going to look strictly at the source material to decode the FNIB designation. To truly understand financial reporting standards today, we first have to take a look at the macro framework, because a major shift happened recently. In August of 2022, the International Sustainability Standards Board, or the ISSB, which is part of the IFRS Foundation, officially assumed responsibility for the SASB standards. So when we talk about industry classifications today, we are actually talking about a globally recognized framework that's designed to align sustainability-related financial disclosures all across the world. Okay, let's dive into this. Here is our roadmap for today. First, the SICS classification system. Second, defining the FNIB code. Third, the pure play rule. Fourth, core investment banking activities. And finally, number 5, the unique risks of FNIB. All right, starting right at the top with Section 1, the SICS classification system, a macro view. So SICS stands for the Sustainable Industry Classification System. It is an incredibly comprehensive framework that categorizes 77 different industry-specific sustainability accounting standards. But it doesn't just lump companies together randomly. It categorizes them based on shared business models and activities. And why does this matter? Well, think about it this way. Measuring the carbon footprint of a global tech manufacturer requires a totally different set of metrics than measuring the systemic financial risk of a bank, right? A one-size-fits-all metric simply fails. This system helps entities pinpoint the very specific sustainability-related risks and opportunities that affect their cash flows and overall cost of capital. It's all about finding the exact right lens for the exact right business model. But here is where we run into the core tension of our explainer today. I absolutely love this quote directly from the standards. It states that companies with substantial business in multiple industries need to consider additional standards. Picture the massive, sprawling global financial conglomerates of the world. They aren't just doing one thing. They're a complex web of totally distinct industries all living under one single corporate umbrella. To properly measure their impact and risk, we need a highly precise map to navigate those separate operations. Which brings us to Section 2, defining the FNEIB code, right within the financial sector. Meet the star of the show, the FNIB code. This stands for Investment Banking and Brokerage. Now, we need to zoom out a bit and really grasp the true scale of what this code represents. These are not your local credit unions taking checking deposits. Entities categorized in this specific industry are the absolute titans of Wall Street and global financial hubs. They perform vital, high-stakes functions in the capital markets, basically pulling the levers of the global economy by raising and allocating capital, making markets, and offering highly complex advisory services for corporations, institutions, and even sovereign governments. Moving right along to Section 3, the pure play rule, drawing the boundaries. Now, what's really interesting about this slide is that to truly understand the FNIB code, we have to grasp why the standard focuses so strictly on the pure play rule. We literally have to actively isolate pure play investment banking from the other everyday financial services that operate under the exact same corporate roof. Why surgically extract these activities? Well, because pure play investment banking carries massive, high-speed global risk profiles. If you mix high-octane capital market activities like proprietary trading with the slow, steady metrics used to judge consumer banking or basic mortgages, the true risks just get completely buried. The standard separates them entirely so that the distinct, aggressive nature of investment banking can be accurately measured on its own merits. To pull off that isolation, the standard establishes a really strict rule of exclusion. FNIB explicitly does not include mortgage finance. It completely excludes commercial banking, consumer finance, asset management, and insurance. Every single one of those has its own totally separate code and metrics. By systematically stripping away commercial banking and asset management, the standard successfully removes the noise. What you're left with is a concentrated, pure look at the high-stakes capital market activities. Okay, Section 4, core investment banking activities. What's included? So, if we exclude all those broader financial services, what revenue-generating activities actually define this pure play bucket? Instead of just reading a list here, let's group these dynamically. On one side, you've got fee-based advisory and facilitation, financial advisory, securities underwriting, and securities and commodities brokerage.
In these operations, the bank is essentially acting as an expert middleman. But on the other side, you have the principal risk-taking operations, where the bank actually puts its own capital on the line. That's your market-making, proprietary trading, and securitization. This is where the bank steps out of that advisory role and directly buys, sells, and repackages assets for its own or its clients' accounts. And this brilliantly illustrates how capital actually gets raised in the real world. Let's look at underwriting. Say a massive tech startup decides they want to go public. They don't do it alone, right? They hire an underwriter, a pure-play investment bank, to raise that investment capital from investors on their behalf. The bank steps in to issue either equity or debt securities, managing the whole shebang from highly publicized initial public offerings to complex cross-border private placements and acquisition financing. Then we have securitization. This is the process where banks take other financial assets, think corporate bonds, student loans, or commercial mortgages, combine them into a brand new financial instrument, and then market the different tiers of those repackaged instruments to investors. It's like a giant puzzle of asset transformation. And honestly, it's really worth noting that this exact process of repackaging and marketing tiers of assets was right at the absolute epicenter of the 2008 financial crisis. That historical context immediately highlights exactly why regulators and standard setters care so deeply about monitoring this specific SSCIS code today. Which naturally leads us to Section 5, Unique Risks of FNIB, Systemic Impact and Incentives. Now that we know what activities make up the FNIB industry, we really need to understand the concept of too big to fail, because pure-play investment banks generate revenues from incredibly fast-moving global markets. They are extraordinarily interconnected. If they fail to manage risks to their capital, it creates a massive contagion effect. Their failure can literally disrupt the entire global financial system. Because of this systemic risk, regulators require these specific banks to undergo extreme stress tests. They have to measure their ability to absorb financial shocks using a global systemically important bank, or GSIB score, which, by the way, is reported in basis points. To measure this systemic risk, that GSIB score isn't just one arbitrary number pulled out of thin air. It's meticulously calculated using a methodology across 5 distinct categories: size, cross-jurisdictional activity, interconnectedness, substitutability, and complexity. Take interconnectedness and substitutability, for example. Regulators are basically asking, hey, if this bank goes under tomorrow, who else gets dragged down with them? And is there another institution capable of substituting in to seamlessly take over their massive market-making operations? Measuring these things ensures the global economy can actually survive adverse conditions. So the crucial point is that systemic risk isn't just a product of invisible market forces. It is heavily driven by human behavior inside the bank. That brings us to how compensation structures can totally incentivize excessive short-term risk-taking among key employees. Standard setters specifically zero in on a group called material risk takers, or MRTs. We're talking about senior management, heads of key business units, or simply the top 10% of the highest paid employees. It's a fascinating reality that standard setters focus so intensely on this specific cohort, knowing full well that the personal risk appetites of a firm's top earners have the potential to destabilize the global economy if they're improperly managed. Because of this human element, standard setters scrutinize the exact breakdown of how these material risk takers get paid. They closely evaluate fixed remuneration versus variable remuneration. Variable pay, like those massive year-end bonuses tied to short-term performance, can definitely incentivize some wild risk-taking. To mitigate this danger, regulators want to see exactly what percentage of that variable pay is subject to malus or clawback provisions. Think of a clawback as a financial time machine. It literally allows a bank to reach back and undo the reward for a risky bet that eventually blows up years later. It ensures the employee shares in the long-term consequences of their actions. Pretty brilliant, right? Man, we have covered a tremendous amount of ground today, all the way from the macro SICS classification down to systemic contagion risks and even the financial time machines of employee clawbacks. By intentionally carving out pure play activities like underwriting and securitization from the quiet hump of commercial banking, the FNIB code creates a highly precise tool for measuring market risk and governance. So I'm going to leave you with this provocative thought to chew on. As massive financial conglomerates become increasingly complex and intertwined, is your institution accurately isolating and reporting its true pure play investment banking impact? Thank you so much for joining me on this explainer, and keep learning.